Hi, this is Alan Gassman. Sorry we're starting about a minute late, but it's 11 o'clock somewhere. I'm here with Brandon Ketron. We're going to first do a little introductory deck, which is going to be shameless self-promotion, and then we're going to get on to the title deck. So this presentation does not qualify for continuing education credit. In about 3 hours, you will get a replay emailed to you that you can watch as many times as you want today and tomorrow. And then after that, you can watch it as many times as you want as well. We're continuing our Saturday series. Next week, the Scrat, the Jest, and the E Street Shuffle. Then after that, we're going to do greatest hits from Saturdays, then spousal limited access trusts, and then family installment sales. So keep them coming. If you're in Las Vegas next week, or you can make an excuse to go there now, I'll be speaking on businesses in distress and bankruptcy planning in Las Vegas, and then later we'll do webinars from those presentations. Almost everything that we film here goes onto our website at YouTube, the YouTube library. YouTube pays us for this. We get about $2 a month on average. So please watch it many, many times. Sign up for the Notre Dame Estate and Tax Planning Institute. I'll be speaking Friday, October 22nd from 1:30 to 2:30 p.m. with my hero, Jonathan Blottmacher, the greatest estate planner in the United States of America. That's him, certainly not me. If you are a CPA or a lawyer and you've never attended the Notre Dame Institute, it is virtual this year for the second time, and it is packed with really good and a lot of original content, including Brandon Ketron and Christopher Denicolo on how to keep your slats from going kersplat, a 2-hour program, Wednesday, October 22nd. And then come see us in Miami, Wednesday, November 3rd for advanced strategic planning techniques in asset protection. So, oh, and if you're in Birmingham, Alabama, November 4th, I'll be there with you. Anyway, let me go ahead now and switch to the non-commercial deck. And Kelsey, you may need to help me with this because we will close that off. Don't save it. Now I'm looking for the other deck. There it is. I bring it down and I'm go. All right. Welcome to this presentation of estate planning for business owners. Brandon and I have been working on this for minutes at a time, putting together a lot of slides from prior presentations. We welcome your questions, comments, and suggestions, and we will be answering questions that you put in during the presentation, of course. So we like to sit down with the business owner and say, what are your goals? And how do these goals compare to what your goals were when you started your business or when you first bought your business? Because many of us get into habits of thinking and habits of conduct that are very different than what they can be later. When you started your business 20, 30 years ago, you needed to wake up at 5 in the morning, get there by 6, count the cash register, answer all the calls, and refill the Coke machine. Well, now you're doing all of that except refilling the Coke machine. But what you should do, and that's what David Finkel calls your B time, when you're actually working in your business, that's your B time. Your A time is deciding whether to buy another business. Your A time is hiring someone to do what you do better than you do it. And your A time is sitting with your CPA and your lawyer, what could be more fun, to strategize how your business can improve and how it can be safer. 20 years ago, you took some risks that you don't have to take anymore. You didn't have insurance. Your car didn't even have a spare tire. You worked yourself and only got 5.5 hours of sleep and could have made more mistakes. So it's time to reevaluate that and to use and set aside some A time so that you can make sure that your business is protected. Protected from what? Protected from creditors, protected from estate tax, protected from when you die and your spouse remarries and your new spouse who you've never even met except at a couple of parties ends up owning the business, protected so the business goes to your children if that's where you want it to go, and protected so that you can enjoy your business and not fear your business or find it to be just a big pain. So what's the process for that? The process is designed by you, but at some point, hopefully, every business owner knows what the assets and liabilities and risks of the business are, has a team of qualified advisors, and quite candidly, I can tell you, we work with many, many businesses, and it's always a surprise when they have a weak advisor, whether that's the accountant, the lawyer, the actuary, the insurance agent. Get the best team you can, and they should not be from one company. Anybody who pretends to know both tax, law, and accounting, and investments and insurances is a danger to you. You need, in our opinion, independent advisors. We don't always work with the same CPA firm. We don't always work with the same insurance agents. We keep them in check. They keep us in check. Go with a good team of advisors. Next, educate yourself. Spend that A time. Spend 40 hours of your life to protect 100% of your assets, to understand how these rules work. How does taxation work? How does tax law work? How does estate planning work? Learn that, or make sure you're working with somebody who will apply it to your situation. So next, please run your business responsibly. Would you want your customers to do what you do behind closed doors? We all took risks when we started our businesses or practices. And then we got to the next level and the next level. And now, if you're doing something that may not be according to Hoyle, you don't have the right kind of insurance, you're maybe possibly breaking a regulation here or there, go ahead. You can afford to fix these things, and you can afford to run your business responsibly. Your business should not be a house of cards. So we do strongly recommend that clients find a good, independent, qualified CPA who will roll her sleeves up and talk turkey about what this business needs, how it compares to other businesses, and what to do. And at the bottom here, I used to work for the IRS. A lot of accountants used to work for the IRS, and clients say, wow, he used to work for the IRS. He must know a whole lot. Well, the IRS doesn't always have the best training programs. So you want a CPA who really knows their stuff, and not a CPA who just makes things up to save you tax money and expose you to criminal prosecution. So be careful with that. On the pension planning side, please have your census reviewed by a good pension actuary. That's not a lawyer, that's not a CPA, that's not your stockbroker. That is somebody who is very, very mathematical and has very good software to show how you can put the most away for yourself and less away for the rank and file. So most clients who come to us have not had a good actuary look at their plan, and we end up improving the plan simply by recommending a good actuary and making sure that it gets done. And actuaries rarely charged to tell you what they are able to do for you, because so often they'll then be able to do your pension plan work. So then, out of self-interest, Brandon and I put these slides in. Get your estate planning done. Make sure that you go through a checklist of what to assure is handled in your estate and asset planning. And this questionnaire was from a Florida bar presentation that I gave a few years ago about, reminding lawyers that there's a lot to do in an estate plan. And quite candidly, sometimes we get talked out of doing these things, because if we meet with 10 clients and 3 of them moan and groan about, well, I don't want to get you my whole asset list, and do you really need to see my S corporation tax return? and I don't want you to help make sure that my parents don't pour their assets into the wrong place when they die. And can you please keep the price down on that? Well, the lawyer gets used to that, and the lawyer starts doing the minimum for everybody. So what I like to tell my friends is, you know what? When I go to the doctor, I want to be an A client. I want to be the favorite patient of that doctor, because when I get sick, I need help. So I'm going to tell the doctor, thanks. Is there anything else that you would do for yourself or a family member that you haven't done for me today? And by the way, if my health plan doesn't pay for certain tests or treatments you think I should get, I'm good with that. I brought my checkbook. I'm glad to pay. And by the way, I'm not going to grumble and complain to your receptionist about something, because I don't want your whole office to hate me. And so just think about that. Proper care and feeding of your estate planning lawyer. That if you do the right things for people, people will do the right things for you. But when I walk into my doctor's office, I have a list of things I want to make it covered, because my doctor may not have time to think about all these things. So learn a little bit about what we do. And for those of you in the audience who are estate planning lawyers, I hope you enjoy this list and use it. Now, slide 15 is a typical estate plan, and we just have it here because whatever your plan is, you should be able to have it on one page with you and every entity being a circle, ownership below the entity. And you should know how the entity is taxed, what it is, what its purpose is, and whether a creditor can reach it. And what happens to that entity when you die, and what happens to that entity when your spouse dies. And we've covered all this in the prior Saturdays, so I don't know that I'm going to spend a lot of time on it, other to say that I hope that you know what your entities are and how they all work. And if not, please assign that as something that you want to do this year. And when a client dies, will the business be in the trust? If you've set up a beautiful revocable trust, have you titled the stock in your company to the trust? Or is it better titled jointly as tenants by the entireties with your spouse? Or should it be under your spouse's trust? What is the plan? If one of you dies, do you want it locked up in a trust? Do you want a stepped up income tax basis on death? Do you want it to go to the children? Do you want to gift it now to avoid estate tax? Please don't be an accident. Please don't be a generality. Have intention as to what your estate plan is and what your business plan is and how they go together. And there's a lot of different things that a well-qualified advisor can point you in the direction of, but make sure that you get the basics right. Now, Brandon, give us a little preview here of what this slide is, and talk a little bit, if you would, about estate tax planning.
Mm-hmm. Yeah, so that's one of the things, when you have, a typical client would come in that is estate taxable, the question becomes, well, what can we do to not only protect you from creditors, from divorcing spouses, from other liability issues, but also how do we protect you from the estate tax? And, that conversation starts with understanding what the assets are, understanding what the assets are going to grow to, what they're expected to grow to. You have to really have an understanding of the business and how it operates and what the client owns, how much cash that they have. And then you can really start to plan for how are we going to reduce the estate tax? How much can they pass along to a trust for their children, or maybe a trust for the benefit of their spouse? So that's the initial conversation. Once we get our arms around that, then, we can look at gifting, we can look at installment sales, we can look at all those tools in the toolbox that Alan had on the previous slide and see which one fits best. It's not a one size fits all. It might be a combination of things. So you really have to tailor it unique to the client situation. But I will say one of the more common things that we do is an installment sale to a defective grantor trust. And we've talked about this several times on Saturday, but to go through it again, it really is a really, I guess, one of the better tools to save estate tax. So just to go through this situation here on this slide, here is we have T&T Industries. It's the client's business. It's valued right now at 12 million because it throws off $3 million of net income each year. So if we do 4 times earnings, that gives us the value of around 12 million. So how can we use this company to save estate taxes? Well, client says, I don't necessarily need any more income. I have plenty of cash set aside. I'd rather just have this company pass to my children. And we're like, great, that's an excellent idea. Let's do an installment sale. So how do we do this? Well, first we have to get an official valuation of the company. That's done with an independent appraisal. That's the best case scenario. So that appraisal might tell us that since the company's valued at 12 million, when you're only selling non-voting stock, we can take a discount on that. It might be around 30%. It could be 20%. It just depends on the provisions that are in the operating agreement, what the appraisal says that discount would be. So let's go with 33% for this example. So we sell the non-voting interest for $8 million. That's a 33% discount off of the 12 million. And the trust purchases that interest in exchange for a promissory note owed back to the client for $8 million. It can be 20 years at 2% interest approximately based upon the applicable federal rate for today. So what exactly does that accomplish for us? Well, for one, it freezes the value of this business at $8 million plus that 2% interest rate. And what that means is all future growth of the business can go under this irrevocable trust. So let's take a look at what that might look like. In 5 years, the company might be worth $20 million. In addition to that, for those 5 years, this irrevocable trust receives that $3 million of income. And guess what? Because of the way this trust is set up, client pays the taxes on that income. And that's not deemed to be a further gift to this trust. So that further reduces the value of the client's estate and allows the assets in that trust to grow tax-free. So we have a $20 million company. We have $15 million of income that we've got tax-free that we could invest in the market. So the trust at a minimum is probably worth $35 million. It pays off the note. And now after 5 years, we have a value of $27 million in this irrevocable trust that's not subject to estate tax, that's protected from creditors. So this is a really efficient plan, not only for asset protection, but also for estate tax planning.
So that's a great explanation. So let's go into a little bit more detail also. For this particular client, the entrepreneurial person who primarily leads the company, owns the stock. So he can sell the 99% non-voting member interest to an irrevocable trust that will be held for the health, education, maintenance, and support of his wife, who can be the trustee. And she can decide how the trust passes for their descendants, or possibly even for him in the event of her death. So this can be very powerful. Now, this particular client, they don't have a lot of cash, but they have a lot of real estate investments. So what's going to happen is at the end of the first year, he's going to say, man, I owe $1.5 million in tax between federal and state taxes. Where am I going to get $1.5 million? Because of this trust, I owe the tax. Well, we're going to transfer $1.5 million worth of real estate LLC interests into the trust in exchange for $1.5 million cash that comes from the company's profits. And as a result of that, $1.5 million of discounted real estate LLC interests are going to get out of the estate tax system without that being considered to be a gift. Now, will this be grandfathered if Bernie Sanders gets all his wishes? And the answer is, I think it will. That is the history of estate and gift taxation. That is a way for congressmen and senators to increase the estate tax without making all of their constituents angry, because the ones who are smart enough to get this into place would have it grandfathered, but it could prevent future sales. So get this done sooner rather than later. I would guess that only 40% of the business owners out there have gotten this done. Lawyers and CPAs, please reach out and let people know that this type of technique is very viable. It's not overly aggressive. And I mean, look at the estate tax savings. If this business sells for 50 million later, which is not unusual, then you've got all those assets out of the estate tax system. Yet the client can control the trust because the client is able to set up LLCs under the trust and be the manager of the LLCs and invest the assets. So Kelsey, are we ready to do a polling question? Okay, so this is our first ever polling question, and we're doing it just for the fun of it because we want to see if anyone would like to answer a polling question. And the question, what do they need to know, Kelsey?
The question is going to pop up on your screen.
Okay, so you should have the question now, and then if you go to the poll, the question is, number one, business owners can reduce estate tax by A, just owning non-voting stock, because if you give the voting stock to a trust and you keep the non-voting stock and you die, then the estate tax will be reduced. B, as Brandon just showed you, selling non-voting stock to a spousal limited access trust or other trust. C, just giving stock away over time using your $15,000 a year per person exemption to people or to trusts, or D, all of the above. So the right answer is D, and 92% of you have pushed D, 6% pushed B, and 2% pushed A, and we have had our first polling question in the history of our law firm, which was founded by me in 1899, immediately after I invented the internet. Right, how do we get out of this?
You are now out of it.
And we're out of it. All right, go Kelsey, good job. Okay, Brandon, what do we have here on page 23?
Yeah, I'm missing the deck. I don't see it showing back up.
Okay. Never mind what I said, Kelsey. Okay.
There we go.
All right.
So slide 23 basically just shows all the different options we have when we do make a sell and transfer assets to that trust. So we can do it with a standard installment note. As of July, these rates change monthly. If you just Google index of applicable federal rates, then you can find the list and see what the rates are for the current month you're doing the transaction. Now you can either use the current month or the prior two, so you get to pick the best of three. But in July of 2021, the rates right now for a note of less than 3 years is just 0.12%. So even if you have just a bond portfolio that's earning 1-2% interest, you could transfer that and sell that for a note for 3 years of 0.12%, and you would still have a little arbitrage there that you could pass some growth to an irrevocable trust. A 9-year note, 1% interest, that works really well, or a longer than 9-year note, 2.07% interest as of July 2021. I did just look up the August rates because they are now published, and that rate actually went back down to 1.98%. So it's getting even better. And these rates, if we can lock them in for 20, 30 years right now, we would expect assets to grow above these rates, and that would be very useful for estate tax planning. Now, another unique item here is the SKIN, the self-canceling installment note. Works similar to the traditional installment sell, with the exception that if the note holder, so the client, passes away during the term of the note is canceled and the principal isn't due. So if you have an $8 million note like our prior example, the client passes away in year 10, and you only would have to make the interest payments. You wouldn't have to make that large balloon principal payment, and that would all result in significant estate tax savings. Now, the disadvantage of that is because of the risk that the client would die during the term of the note, you have to charge a higher rate of interest. So in this situation where you have a 73-year-old using those current applicable federal rates, the premium would be around 4.5%. So the total interest rate would have to be around 6.6% interest versus the 2.7% interest or 2.07% interest on a typical normal installment note. So if the client is going to pass away earlier than their life expectancy, the SKIN can make a lot of sense. If they are healthy and projected to live longer than their life expectancy, then maybe the skin doesn't make sense because of that higher interest rate. You just have to look at that, assess the situation, and run the numbers. Now, another alternative is a private annuity. It works similar to a skin in that the earlier you were to die, the better off it is from an estate tax standpoint. So if you make $1 million transfer here, based upon the life expectancy of the client, they could receive in exchange for $1 million, $89,736 a year. That was received into the rest of their life. So again, you can see the crossover here. Basically, if they live 11 years or longer, then they're going into the negative. If they're to pass away before that 11 years, then we probably have some estate tax savings. Another twist on this is a Grat, Grant or Retained Annuity Trust, where you would transfer assets and get a annuity payment in exchange equal to the actuarial value of those assets transferred. So here, $1 million for a 3-year Grat would be around $341,000 each year. So those are just some different wrinkles that you can throw into the installment sale based upon the applicable federal rates.
Okay, so let's go back now. We have lots of slides for these, and you're welcome to use them. Business owners and CPAs and lawyers need to be very mindful that there are a lot of alternative ways to own a company. It's easiest to put it in Ma and Pa Kettle's names, but it's not always the best idea. Or to put it in a joint trust so you can get a step up on the first death. But does that cause everything to be subject to creditors if one spouse is in an accident? So an S corporation, which is the most common form of a business company in the United States for good reason, because the income goes through and is not generally subject to employment, can be owned by an irrevocable trust, could be owned by a 501c3 organization, a charity, could be owned by a small business trust, could be owned by a qualified subchapter S trust, you through Section 199A planning. And in Section 199A planning, you could save 20% of the income tax that you would otherwise pay by using your children's or grandchildren's brackets. So the question needs to be asked, what sort of entity should I be using? Should I be using a regular corporation that I'm in now that's an S corporation? Should I convert that to an LLC so that if a member gets sued, the creditor can't reach the member's interest, even though the LLC could be a continuation of that corporation? And in particular, how are you going to own real estate? Page 66. I get a lot of headaches seeing clients who have put, I thought it was page 66, sorry about that. A lot of headaches I see from clients who have put a lot of real estate into S corporations. And then when the client dies, you don't get a stepped up basis as you would in a partnership. When somebody wants to invest, you can't do a preferred common arrangement like you can with a partnership. You can't move the real estate out of the S corporation without triggering an income tax. S corporations are usually not the best way to own real estate. And if you have real estate in an S corporation, you may be able to start working your way out of it by talking to your advisors. The only time that we like S corporations to own real estate is if there's an insolvency or a bankruptcy situation. So I just think it's important to kind of think about this chart, have it available, and look at it. But what is dearest and nearest to most clients' hearts, for good reason, is will this all be taken away from me because of a lawsuit? And last Saturday, we went over some of these lawsuits where somebody left a hypodermic needle on the parking lot of Target, and Target offered $750 to settle the suit, and the jury awarded the lady $4.6 million. If you're in construction, you've got to understand that building that just went down in South Florida. Imagine if every person in that building was entitled to $148 million. And how many times have clients told me, well, I'm a contractor, but I have 10 million of coverage. I think I'm fine, right? Well, this lady got a jury verdict of 148 million because the bus stop she was under got filled with rain and collapsed on her. So we have to be very careful, especially when you have cars driving around. So One thing that we have here for you is a white paper that we've been working on, and it's here on page 78. And at least under Florida law and under the law of most states, you can separate your vehicles and your drivers from the rest of your business. And I learned about this back in the early 1980s or the mid 1980s. I represented Dr. Miranda, and Dr. Miranda was in a car parked at a red light and was rear-ended by a Kane's furniture truck, and it was driven by a drunk installer. But Kane's Furniture had been smart enough to put their trucks and their installers in a separate company. So her judgment against the Kane Furniture Installation Company did not penetrate to the main Kane's Furniture Company. So the question is, can you reorganize your business to the extent that the goose that lays the golden eggs, the storefront where the people come in and buy the carpet, or the storefront where you make the sale and commit to deliver the merchandise, can the delivery of the merchandise or can the manufacture of the merchandise be different from the sale organization? Because then if you have to bankrupt out your merchandise company, can you keep your sales organization, which is the goodwill of the business? And to a great degree, you can, or you should at least try. And one great example is the Silver Inc. case, where, believe it or not, the entire DHL operation of Jacksonville, Florida is not owned by DHL. It's owned by a franchisee. And the franchisee has to have DHL style trucks, DHL style costumes, uniforms, DHL style procedures. Yet somebody killed by a truck in Jacksonville can't reach DHL, or at least not easily. And you can read this case. It was a close call, so the appellate court sent it back to the trial court. And there are other cases like this. In fact, we found a recent case where a school bus ran over somebody, but the school system had contracted out the school bus operation to an independent contractor company owned by the school system. And then you have the highlight case. The lady is walking up into the highlight fronton and she gets hit right at the entrance by a valet parker who's wearing a valet fronton uniform at the fronton, working for a subsidiary at the fronton, and the fronton was not responsible. So separating the goose that lays the golden eggs from the other part of the entity is really important. And this can be done tax-free. You may have an appreciated asset in an S corporation, and you think you can't move it out even where it's goodwill. So you have like a medical practice here on page 73. Under IRC section 368A of the Internal Revenue Code, you could set up a new parent company. It's an S Corp. Have the medical practice company owned by the new parent company, and then set up brother-sister LLCs or neutral gender LLCs. You can have a brother, a sister, and a neutral gender LLC, 3 of them. And then you can move the assets from the medical practice. The equipment can go in this LLC, the furniture can go in this LLC, the long-term accounts receivable, known as letters of protection, can go in the neutral gender LLC. And then when somebody sues the medical practice, after all this is separated, they're not going to be able to get into the other items. So I'll briefly show you this polling question. We're not going to do the poll. But a new parent F reorganization, A, refers to an Internal Revenue Code section 368A1F organization. B, permits tax-free division of assets otherwise stuck in the S corporation. C, this is new, the subsidiary can keep its taxpayer identification number and name. The parent company, though, takes the tax identity or the tax characteristics of the subsidiary and continues with a new tax return. And D, which is always the answer when we do these, in case you know or care, all of the above. So that is stuff that's really important to sit down with your advisors and talk about what are my liability issues and how can I seal off that liability. And we have a really nice checklist that was developed with the assistance of a financial advisor named Glenn Main, M-A-I-N. He's not in Maine, but his name is still Glenn. And he asked me, what would you do for a client to try to check for liability situations? And one thing I would check is I want to see your agreements with customers and suppliers. I want to make sure that the responsibilities of your company are limited and that the liability of your company is limited in the agreement with your customer. I want to see that the liability of the customer is clear for what the customer is responsible for. And I want to make sure that you have warned the customer about the primary risks. You know, we're going to build a pool, but we may kill your animal with our truck. And our truck is heavy. It may crack your driveway. And don't let small children play near where our construction site is. And some of our materials are poisonous. Don't eat them or let your dog eat them. And then I want to have limitation of liability provisions. Yes, we are providing you with a pool, but the most we will owe you if we accidentally wreck your house is the cost of the pool and no more. And that may be enforceable. E, we don't ever want to go to a jury trial if we can avoid it. We want to go to a trial by judge or an arbitration. Imagine a doctor's office, an OBGYN, that has had my wife sign an agreement that says that if she sues them for malpractice, there will be an arbitration and the arbitrators will be doctors. And yes, we signed it because we want our doctors to feel that they can do their job without having to worry about getting sued. And then making sure there's plenty of liability and casualty insurance. Have you gotten a second opinion from another liability agency as to what your liability and casualty insurance situation is so that they can save you money and get you more coverage? Page 57, your organizational charts. Do you have a chart structure? Do you understand which of your entities will be responsible for problems and which of your entities will not be responsible for problems? Have you segregated your motor vehicles? Don't have a motor vehicle in the name of a business company that has significant assets if anyone's going to drive it outside of business hours at least. I mean, I am responsible for the driving I do or that my receptionist does for me during business hours. But when I drive that car home, and most accidents happen at night after drinking or in the rain, I don't want that car titled in the name of my company. If it's stuck in your company now and you don't want to trigger tax, move it to a subsidiary LLC. Or give the car to your receptionist. If you really like your receptionist a lot and she drives your car a lot, give her the darn car. You don't want to lose all of your assets. So the same applies to boats and airplanes. Page 58, get involved with the insurance coverage. Like I said, page 59, the tax savings can go hand in hand in this. One idea is to let your children form a company that services your company and let a lot of the profits from the arrangement go to your children's company. Then you haven't even made a gift for estate and gift tax purposes, and you have a lifeboat entity if things don't go well or you have a creditor problem. There's a famous tax court case about 5 or 6 years old called Boss Trucking, where Mr. Boss, or is it Bross, I forget, has an R, maybe he couldn't afford an R, I don't recall. Anyway, he let his children set up a competitive company and he didn't complain about it. And suddenly a lot of the trucking was in the kids' company and not his company. And the question was, did he make a gift to the kids? And if he had been sued, then the creditors would have not been able to shut down everything because his kids' company could have taken over his accounts. So just all good things to think about, great things to worry about, and things that we just want you to be aware of. So I'm going to go to the next polling question, which revolves around another important thing, and that is called equity stripping. Now, this has nothing to do with nudity, but if you take this in the hot tub with your significant other, these slides can be very interesting. If the deck slides were moving, my deck just jammed. Let me see here. Think you can fix that, Kelsey? Oh, there's the mouse. All right, sorry about that. See, I got excited with the nudity and all that. But anyway, equity stripping can be summarized by, let's find an easier example. John has rental houses, 10 of them. He owns them free and clear. If you sue John, he will lose all of the rental houses. So what does John do? John goes to a lender and he borrows $2.6 million and he puts it into an irrevocable asset protection trust that his creditors cannot easily touch. And now he pays interest to the lender. Well, the lender may be his mother, who would like to loan him money at 1% interest. Or the lender may be an offshore bank that charges him 1/2 of 1% per year for this being just a creditor protection arrangement. So that's a typical example of equity stripping. And we have other examples here. First, you own a $5 million building. You borrow $4.5 million. You put the $4.5 million into a separate irrevocable trust and keep $500,000 around. And at the end of the day, there's no equity left for the creditors. So that's equity stripping. And our polling question at page 952. Equity stripping means 1, not related to a hot tub. That's mostly correct. 2, having friendly debt owed by an entity. And 3, it's best if the debt is secured by a lien on the assets of the entity, or at least the note allows the note holder to put a lien on. And the correct answer, as always, is all of the above. Now, if you're in an S corporation and your CPA says you can't borrow money under the S corp or you'll trigger tax, have your CPA send us an email or review what we've said about IRC section 368F, A1F, and the F reorganization, or I can send you an article on F reorganizations. They are really, really effing great. All right. Brandon, do you want to talk about charging order entities? By the way, every time Brandon laughs at one of my jokes, he gets $25 worth of Starbucks gift certificates.
All right, we're on a roll today then. I think I maybe laughed twice, so I think we're in good shape. One's about the nudity and one's about being effing great. So charging order is another valuable tool that we can use to really protect assets. And it varies by state. So you have to be careful, and it depends on the state that you live in. But particularly here in Florida, charging order protection is alive and well. We want to look for states where charging order is the sole remedy for creditors. So what exactly is charging order? Well, it is essentially that if you have a creditor that sues the business or sues you, can they liquidate and receive the assets under an LLC? So let's say you get into a car accident, you owe the creditor $10 million and you have $10 million of assets under an LLC. Can that creditor get that $10 million under the LLC? And the question depends on how it's owned. If you have it owned 100% by you, then it's what's known as a single member LLC, and then the creditor can liquidate that LLC and get to that $10 million. But if you have two members, maybe you have it owned 1% by your child, 1% by an irrevocable trust that's disregarded for income tax purposes, that's for the benefit of your child. Therefore, you still have a disregarded entity. You don't have to file a tax return, but for state law purposes, we have two members of that LLC. So when we have two members, the creditor can only get a charging order, which means they only get distributions that are made from the LLC, but have no rights to force you to make any distributions, no right to force you to liquidate the assets of the LLC. So the creditor's really stuck. They can't get to that $10 million. So we can negotiate down the settlement with the creditor, hopefully settle for pennies on the dollar, because they're not ever going to be able to get anything under that LLC. Now, there are some states that don't have charging order as the exclusive remedy for creditors. So then maybe you set the company up in a state that does. So you can look at that as well. So charging order, very valuable and very easy to do. So don't forget about this, and it's a great way to protect assets.
Now, when there's no charging order protection in the state that you're in, you can have voting and non-voting stock. So I own 1% voting, 99% non-voting. I give my daughter half of 1% voting. Now, a creditor who takes over my 0.5% voting and my 99% non-voting is at a deadlock with my daughter, and I'm the president of the company or the manager. They can't get rid of me. So it's still not a cakewalk for them.
Mm-hmm.
One question, believe it or not, that we don't know the answer to for sure is if I live in a charging order jurisdiction, such as Florida, and I set up an LLC in Colorado, which does not have charging order protection, do I get charging order protection if the lawsuit against me is in Florida? And the answer is, we don't know. But if you live in California or you live in Colorado where they don't have charging order protection, form your LLC in Florida or Wyoming or one of the entities that has charging order protection. And according to a recent Iowa Supreme Court decision, and as you know, the Iowa Supreme Court is the leading Supreme Court in Iowa. It's very well respected in Iowa. They said that the law that applies when a Florida married couple set up an Iowa LLC, not Florida law, because the couple was trying to get tenancy by the entirety's protection, but was Iowa law. So if you own a car dealership in California and you want to have charging order protection, set up a Iowa LLC because they have charging order protection and their Supreme Court says you're protected, and have your Iowa LLC own your California dealership. So, and yes, the state of California now is going to charge you $800 a year for the privilege of owning a Wyoming LLC. So if that's a problem, you might consider setting up a New Hampshire or Wyoming foundation, which gives you limited liability and maybe limitation from creditors better than charging order protection, and is not considered to be a company under the California $600 or $800 a year rule. Okay, if anyone's still awake, I'm now going to go to, by the way, we'll have to do a creditor protection for, a business owners part 2 in a few weeks. But I'm going to go to page 170 now, the final polling question. And this deck may be used, this recording may be used in the future for continuing education. So I have to prove that I can count to 170. All right. Here is, now, you want to deploy it?
Yeah.
Okay. Kelsey's going to deploy it. Everyone hold on. If the ground vibrates, that's what it is. And if you have wet hair, do not touch your computer with both hands. Here we go. All right. Polling question. Number 4, bankruptcy rules for corporations. Those of you who are lawyers and accountants, we want you to know these rules. You can lose your attorney-client privilege in bankruptcy. So what you say to your lawyer may be held against you. So get another lawyer to represent the company that may go bankrupt, and you get your own personal lawyer who doesn't represent the company that goes bankrupt. And then you have 3 lawyers, the lawyer you used to have, the new corporate lawyer, and the new personal lawyer, so that our incomes can go up and your exposure can go down. B, when you have an insolvent company, the officers, managers have a fiduciary duty not to the shareholders, to the creditors. So get a lawyer who advises in that area and act on the advice of that lawyer and his or her malpractice insurance policy. You don't want to accidentally commit a federal crime or get punished in bankruptcy court or state court. C, the preferential transfer rules are really treacherous. If you pay a related creditor and then go bankrupt, that related creditor may have to put the money back unless you do it in a careful way. So when you're dealing with a company that may go bankrupt and they pay you, you may have to put the money back unless there is a contemporaneous exchange of value at the time you do it. So be careful with the preferential transfer rules. There is no CPA client privilege in bankruptcy. So be careful with the communications with the CPA. And the answer, of course, to the polling question is D, all of the above. And Kelsey, 99% of the people said D and 1% said C. So we have a very, very smart audience today. All right. So I have some slides on bankruptcy that I'm going to present in, where's my cursor? That I'm going to present in Vegas next week. Number one, keep your communications under the attorney-client privilege. If you need a CPA to get involved with your financial advisory work and you're facing insolvency, get a lawyer to hire a separate CPA, not the one you've been using. Could be the best friend of the one you've been using, if the one you've been using has any friends. But keep that under the attorney-client privilege. Number two, if you're a lawyer and you end up being a witness, all your notes, your internal memoranda, et cetera, are going to be available to the other side. Three, the attorney-client privilege in bankruptcy doesn't work if the attorney has actively assisted the client in avoiding creditors by making what we call fraudulent transfers or voidable transfers, according to one U.S. Supreme Court case. Now, that has not been blessed by the Iowa Supreme Court, but it was an opinion by Justice Sotomayor of the U.S. Supreme Court, and it was a utter disappointment to many cows. Number four, filing bankruptcy does implicate the preferential transfer rules. Let me give you a horrific example. I guarantee a lease for my daughter-in-law. Her rent is $10,000 a month. She pays the rent, no problem, and then she files, the corporation files bankruptcy owing $1 million, not to the landlord was paid in full, to other creditors. How much do I owe into the bankruptcy estate? The answer is $120,000 because I'm related to my daughter-in-law, and every time she made a rent payment, it relieved me as a guarantor from the obligation to make the rent payment. Isn't that crazy? So the next time that you are going to guarantee a lease for your daughter-in-law, have her divorce your child so she's unrelated, and then the look-back period will only be 3 months. So we do have a book on bankruptcy, and if you would like to see our beta version, because we're in the process of updating our bankruptcy book, if you send me an email, agassman@gassmanpa.com, just put B-book or something like that in the RE line, and we'll send you a PDF of what we've been doing. Please don't forget the doctrine of respondeat superior, which means anyone who works for you is your darn responsibility unless they are an independent contractor. And even though it's very hard to be an independent contractor versus an employee under the tax law, it is much easier under state law. So you could have structuring where individuals who work for you are considered to be independent contractors by contract, even though you withhold and pay taxes on them as if they are employers. So now, Brandon, I want to answer questions for 5 minutes, and then I'm going to turn it over to you.
Sounds good.
Okay, here's a good question. What is your advice on getting all information from a client and not doing the bare minimum? How do you recommend approaching the client regarding fees for services and accumulating and digesting all relevant business, financial assets, and agreements? That is a difficult question, especially for a new professional. I think asking the client for all the information, but then working only with what they give you is important. Because if you say, I can't get started until you give me 97 things, then you will never get started. So it's good to start with a conversation. You could say it is helpful if we have any or all of the following, but not necessary to get the ball started. And then I think sitting with them, because you're billing them for the time, so at least they see the time you're spending. Drawing a circle on your legal pad for each item, having them tell you about the item. If they are not a sophisticated client, that's the best way to get them to step into the pool 1 foot at a time. For a sophisticated client, I think they realize that we can spend $3,000 to $7,000 worth of time just understanding their entities and charting it out. And then if we send out the draft trusts, which only take $2,000 in time, and send them a bill for $7,000, then they think that they paid $6,000 for the draft trusts and $1,000 for the chart. I don't know, it's very difficult. I was doing a proposal for a gentleman a few weeks ago, and I had $5,000 worth of time in it before I even realized that I had that much time in it. So at least those of you who are clients or laymen on this webinar, to be very candid, give your lawyer some time and patience and tender loving care to understand your situation if you want the best services. Okay, here's one. I'm 34 and have $8 to $10 million in assets based on my business valuation. Should I worry about estate planning now? Well, only if you will ever die. If you will ever die, then I would say you should worry about estate planning immediately. Although I know some people you could marry to get that estate value down quickly. But yes, because if your business doubles in value every 10 years, when you're 44, that'll be 20 million, 54, 40 million, 64, 80 million, and 74, 160 million. And then you'll be able to afford to have Brandon do your estate plan. So yes, you should do the planning, and you can do it very flexibly. Okay, without taking Pilates. How to choose between a skin and a private annuity. There's a lot of factors there. You have to go through the factors. There are great articles written by Jerry Hash that are on that topic, but it's great to ask the question, how do you take real estate out of an S Corp into a partnership? Very carefully. What you might do is put the real estate into a subsidiary of the S Corp and then have all growth in value past a certain percentage, like 6% a year, pass through to a separate LLC so that you have the entity here, you've got the real estate here, the separate LLC here, and then the growth gets diverted out. We call that a limited partnership rollout. That is one of the ways to do it. Does Delaware offer charging order protection? Yes, Delaware charging order protection is just as good as Florida's and Wyoming's. Those are the states that we prefer to use. Delaware takes longer to do things and is more expensive to do things. It's harder to get hold of their Secretary of State these days. So we are preferring Wyoming, and Jackson Hole is a heck of a lot nicer place to visit than Delaware. What are your thoughts on equity stripping through a friendly LLC you own in Wyoming that issues a line of credit against the property? That is a possible way to do it. It's certainly better than no equity stripping at all. At what stage does it make sense to relocate to Florida from Pennsylvania regarding income tax? And secondly, estate tax? I would say 3 weeks ago, you should have moved from Pennsylvania to Florida. You'll live longer and pay less, and then Brandon can do your estate planning. And then how do you plan for an ultimate retirement when your firm goes with other partners in an anti-dissolution clause? I don't know. That probably takes some some advanced planning. So thanks again for those of you who attended this, and special thanks if you actually enjoyed it. Brandon is now going to talk about Section 678 planning, which is very important, and also complex trust planning. There is no charge for this extra part, and I think you'll find that it's very interesting. Please send your questions, comments, and suggestions to Brandon and I. Please send Brandon the hard questions and me the easy questions. And Brandon, what page are we on here? I think it's in the somewhere in the 60s, like me.
Yeah, let's go to slide 30. We'll start there. All right, so section 199A, 20% deduction on active business income. The catch is that if you're over a certain income level, then the deduction is either limited or you just don't get it at all. And it depends on the type of business that you are. So here you have two main rules: the specified service trader business, that's legal, accounting, medical, I think there's like 11 of them. We have a slide with the list here, but if you're one of those SSTBs, then if you have income that exceeds basically $330,000 for 2021, then your deduction starts to be limited. And then once you get above 415, that's adjusted for inflation right now. So I think that goes all the way up to 430,000 approximately for 2021. You get no deduction at all. Now, also, if you're above those income limits, you also have to pay a certain number of wages or have basis in qualified property in order to receive the deduction. So the question then becomes, if I'm one of these specified service trader businesses and I have income over the threshold levels, is there any way I can still get my 199A deduction? And the answer to that is yes, but you're probably not going to get it yourself. You're going to have to make some transfers, maybe to your children, which could make sense for estate tax planning, and also to save income taxes. So here we go through the example. If you're a child, and I think the important thing to remember here is, even though this is an SSTB, if you have income below those threshold levels, you can still take the Section 199A deduction. Even if the majority owner over here that owns 90% of the business has income of, let's say, $10 million a year, they don't get the deduction, but the child that has less than 160,000 does. The child that's married that has less than 321,000, that's adjusted for inflation, still gets the deduction. The child over 321,000, sorry, no deduction, because this is a specified service trader business. So going through an example here, before Section 199A planning, we have a medical practice. It pays a reasonable salary to the doctor, has $4 million of income. That blocks Medicare taxes and not subject to self-employment taxes on this $400,000 of income, only the $350,000 salary. So they've done well in that aspect of saving employment taxes. But what about 199A planning? They're getting no deduction here because of their income levels. So what can they do? Well, they can transfer part ownership of the medical practice either by a gift or an installment sale to a complex trust, or maybe a 678 trust for their children. They can set up a separate trust for each child. That's not going to run afoul of the Section 199A rules, as long as this isn't for the primary purpose of avoiding taxes under Section 199A. So you have to have really an independent business reason here. Estate planning is one, liability protection is another. Maybe you want to get the kids involved with the business. Maybe they're doctors themselves. Maybe you're giving them part ownership to reward them for the work that they've done in the business. So those can all be independent reasons other than just income tax planning to set up one or more of these trusts. The other thing is complex trusts are subject to that presumption, but Section 678 trusts are not. So if you set up a 678 trust by giving the child the ability to withdraw the gift made to the trust or withdraw the income each year, then the child, as the beneficiary of the trust, is going to be treated as the owner of that trust and the owner of the stock for income tax purposes. If their income is less than the 199A threshold, then this trust would get the deduction, or the child would get the deduction if it is a 678 trust. Now, the other complication and wrinkle here is a lot of medical practices have to be owned by a doctor or the spouse of that doctor, and so trusts maybe don't work. So what can we do in that situation? Well, we could set up a medical practice management company that does all the billing, does all the filing of medical files, keeps the records, maybe does some other management work on the side for the medical practice, and receives a management fee in exchange for that. Well, then we can gift ownership of that medical practice management company to one or more of those trusts and receive the Section 199A deduction. Now, this related company is still going to be a specified service trader business. So if the income levels are above the threshold, you're not going to get a deduction because of the relatedness of these two businesses. But again, if you have a trust with less than the threshold level, that trust can take the deduction. So we have some information here on the rules related to the complex trust under the final regulations, but I also just wanted to briefly mention some other advantages. So not only could you get the 199A deduction, but if you allow for that trust to make distributions to charity, then it gets the equivalent of essentially a charitable deduction, because it can pass out its income to charity that's not going to be subject to tax. It can make those charitable contributions that you would typically make that you may not get a deduction for anymore because of the high standard deduction, and maybe you don't necessarily itemize deductions anymore. So the complex trust could allow for that. There's also the new SALT tax, the state and local tax limitation of $10,000 for personal tax returns, but complex trust, you get another $10,000. So that can be a way to be able to deduct a little bit more of those SALT taxes. You can spray and allocate income across beneficiaries if you have multiple beneficiaries of the trust. So for example, maybe you have one child that has a high income, the other child has a low income. Well, if you make a distribution to the child with the low income, that carries out the income to that child, and that could allow for the Section 199A deduction and allow for just a lower tax rate to apply in general. So the ability to allocate income across multiple beneficiaries is a great advantage of complex trusts. You can also make distributions 65 days into a calendar year and treat them as made in the previous calendar year. So you have the ability to analyze things at the end of the year, look and see where we're at, 65 days to make a decision. Do I need to make a distribution to carry out income from the prior year? And then 1041s, audits are very rare. So a little bit less likely to be audited than if you have this under a personal name. You might be able to get a new fair market value on death by giving powers of appointment to an older generation. That could work well, an advantage of a complex trust as well. And you can distribute assets that are appreciated tax-free. You don't have to worry about all those partnership mixing bowl rules unless you are treated as a corporation or a partnership for income tax purposes, which can happen if the trust operates a business and doesn't abide by certain rules. So what are the disadvantages here? There's formation costs, there's carrying costs each year. You have to file a tax return, but the advantages generally outweigh these. You do lose the Section 179 deduction, but at least for a little while, we have the 168 bonus depreciation that is almost just as good as the 179 deduction, if not better. So we still have the ability to take the 168 bonus depreciation, just not 179 deductions. As I mentioned, if it's engaged in a business, you might be taxed as a partnership under the trust level and subject to some of those substantial economic effect rules, the mixing bowl rules. So just beware of that. There's fiduciary duty and disclosure issues that you also have to abide by under complex trust. Now, as I mentioned, 678 trust, great tool to use for Section 199A planning. A little bit more information about them here. One other thing we wanted to briefly mention was Medicare and net investment income tax planning. So when you have income that exceeds a certain threshold, you have passive ownership in a business, which generally it means you don't participate by more than 500 hours in the business. That income is going to be subject to the net investment income tax. Also, any other types of passive income, interest, dividends, annuities, rents, all of those are going to be subject to what's known as the NIT tax, the NIIT, and net investment income tax. Now, if you're active in the business, then there's self-employment taxes that apply. So If we're less than 500 hours, we have the NIT tax that apply. If we're more than 500 hours, we have the self-employment taxes that apply. So how do we thread that needle, right? Well, there's a couple of different ways to do it. One of the more common ones that I wanted to talk about here that we can do for estate planning is just consider how it's owned. Now, here we have the situation where the husband, who's the active owner of the business, performing most of the work, maybe this is a professional practice, maybe the husband's a doctor and owns ABC company. Well, husband as the 100% owner is going to be subject to self-employment taxes, but not subject to the net investment income tax, because we can aggregate husband and wife's hours together and be over the 500 hours, and both are considered active for net investment income tax purposes. But what if we have ABC solely owned by the wife who isn't active in the business? Now, for self-employment tax purposes, we're less than 500 hours. Wife's not an active owner, so we don't have self-employment taxes on the partnership income. We can employ the husband so he can still do the day-to-day operations. We have to pay a reasonable salary for the services. That's going to be subject to employment taxes, but at least you have a large amount of income that could pass not subject to self-employment taxes. Now, what about the net investment income tax? You said if I'm a passive owner, then I'm subject to net investment income tax. Well, fortunately for the net investment income tax, the wife gets to aggregate the hours of the husband together. So together they spend over 500 hours, and therefore they're considered to be active, and the net investment income tax doesn't apply. And that aggregation does not apply for self-employment tax purposes. So you're still under 500 hours for self-employment tax purposes. So this can be a unique way to just rearrange ownership and possibly save some of those Medicare taxes. And then also looking at Section 199A deductions and how that can be done as all as part of the estate plan. So that's a brief overview of that. We have more information. There's other presentations that go into more detail on this on our YouTube page. And of course, if you have any questions related to this, feel free to reach out to us, and we'll be glad to provide answers for those questions or address them in future slides. All right, so I think that's it for us today. Thanks for tuning in, and we'll see you next week.